Good day, everyone. You are welcome to this week's Business and Investment Taste Program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the impact of MPC's rate hike and its effect on the economy. The Central Bank of Nigeria's Monetary Policy Committee held its first meeting of the year last week, Monday and Tuesday, 23rd and 24th January 2023, respectively. The committee evaluated the current state of the Nigerian economy against the progress made on the previous decision taken, while also reaching a consensus on a decision that could drive growth and price stability. The MPC is the highest policy-making committee of the CBN and is composed of 12 members, including the CBN governor. The MPC meeting holds bi-monthly, with 5 more meetings expected this year. Surprisingly, members of the MPC voted unanimously to raise the monetary policy rate (MPR). Thus, the MPR was raised by 1%, marking the 5th consecutive increase, following the rate hikes in May 2022 (1.5%), July 2022 (1%), September 2022 (1.5%), and November 2022 (1%). Overall, the MPC was raised to 17.5%, while other parameters were retained. The asymmetric corridors at plus 100 basis points and minus 700 basis points around the MPR, the cash reserve ratio (CRR) at 32.5%, and the liquidity ratio (LR) at 30%. The MPR is the interest rate at which the Central Bank of Nigeria lends to commercial banks. The MPR is the benchmark against which other lending rates in the economy are pegged. It is also used as an instrument to control inflation in the economy. Though the MPR has been ineffective in recent years, the rate has been used to signal CBN's intentions. The cash reserve ratio is the minimum amount the bank are expected to retain with the CBN from customer deposits. This implies that out of every 1,000 naira deposit collected by the banks, 325 naira is expected to be with the CBN. Effectively, the bank can only transact business and earn income with only 675 naira out of the 1,000 naira. To understand more about other key rates, kindly listen to our previous podcast on this topic, link inserted. What are the implications of the rate hike? 1. Rise in interest rates on savings accounts. Given the review of the CBN's minimum interest rate on savings account to 30% of the MPR, and the recent increase in MPR from 16.5% to 17.5%, the minimum interest rate on savings accounts will increase to 5.25% from 4.95% per annum. However, this is subject to other conditions which vary across banks, like limits on the number of withdrawals per month to qualify for interest. 2. Fixed income yields moves in contrast with rate hike. Contrary to an expected rise in yields, rates in the fixed income market have moved in the opposite direction, with the average treasury bills and bond yields declining from 10.6% and 14.3% since the last hike in November 2022 to 1.45% and 13.11% respectively at the end of its most recent meeting. In a similar narrative, yields on the 91-day, 182-day and 364-day instrument moved from 6.5%, 8.05% and 14.8% in November to 0.3%, 1.8% and 4.8% at last week's primary market auction for treasury bills, a day after the MPC's decision. We believe that the MPR has lost its signaling effect on the market as the CBN continues to use unorthodox tools like cash reserve ratio debits and special bills to inject or withdraw liquidity from the financial system. Ultimately, we see the CBN taking advantage of high levels of liquidity in the system to lower borrowings. This makes one wonder why the CBN is pursuing two dissimilar goals at the same time. 3. Higher borrowing costs. Following the 4 rate hikes witnessed in 2022, the banking system has already registered a steady uptick in the prime and maximum lending rate. Through 2022, the prime lending rate increased from 11.78% in January to 13.85% in December, while the maximum lending rate rose from 27.65 in January to 29.13 in December 2022. Generally, during periods of high interest rates, people are discouraged from spending and business expansion and investment are put on hold, thereby leading to a slowdown in economic activities. We see this affecting existing loans without a fixed rate agreement clause, as most banking loans are floating or variable rate based. This means that the loan can be revised upwards or downwards during the lifetime of the loan. 4. More hard times for businesses. Given the increased cost of lending to small businesses, a rate hike would result in an increase in finance costs, thereby shrinking profitability margins. Businesses are also unlikely to refinance existing debts, which could slow investment in their operations. Businesses with inelastic demand for their product will pass the increased cost directly to the consumers. Additionally, this calls for more flexible business strategy to remain above waters. 5. Inflation expected to remain elevated. While a rate hike tames inflationary pressures by slowing down consumer spending, it is important to note that inflation in Nigeria is mainly driven by supply-side pressures, such as a rate hike might not be sufficient to bring down inflation. The pass-through effect of higher production costs will lead to higher prices and higher inflation rates. Also, money supply increasing faster than the economic output (GDP) adds another layer of upward pressure to inflation. Further to this, we emphasize that consumers will continue spending due to the downturn in fixed income yields, as the propensity to save has significantly diminished, making the CBN's MPR move counterproductive. 6. Muted reaction for equities. We expect the impact of the recent rate hike on the equities market will be minimal, as yields in the fixed income space are at odds with the benchmark interest rate. Other factors, such as the start of the full year earnings season and the upcoming election, whichever way it goes, are likely to have a greater impact on market sentiment. Considering that the equity market is the only place that offers the potential to earn positive real return, we recommend investors position for undervalued stocks with attractive dividend yields. However, as the general election approaches, investors should employ a more cautious approach towards investing in the stock market, given its risk. Additionally, investors can consider other options like high-yielding fixed deposits to moderate the negative real rate of return gap. The next MPC meeting for the year 2023 we hold on the 28th and 21st of March, where we believe the MPC may adopt a wait-and-see approach to assess the impact of the cumulative 6% increase at the last 5 MPC meetings. We think the committee will be more hesitant in tightening rates, given slowing inflation and weak growth in developed markets. In our view, inflationary pressures will remain prevalent in 2023 due to the anticipated price adjustment in petrol, expansionary fiscal policy, exchange rate depreciation, and other supply-side issues. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send SMS to 070-8246-3747. Stay blessed.